Okay, let's get started. You ready? We're going to start chapter 11 today, and then on Monday we'll finish chapter 11, and a week from today is your quiz 2. Same as the last time, nothing changes. You know the routine. Working. You ready? Madison? Where'd she go? Madison? Did you know this? Did you look?
I checked it today.
Good for you. We have a new leader. We have a new first place. And I wanted to see what did it for. Did we already? I saw some things in your portfolio and led me to believe we may have talked about it once already in the past. Never? You just happen to have the same thing several other people have then, which is, again, where's Madison, and this is hers right here. I'm gonna make it look better. So when I ask these questions, you can answer them with confidence. Here's her portfolio. My question for you is, which stock looks like it may have helped her get to that first place status? Amazon helped. Netflix. Look at that. 20.98%. 21%. So I remember we talked about Netflix with several other portfolios, and I wanted to see, like, one person got into it before another person, so they were slightly even higher up on Netflix than the other person. So I wanted to see when she got in it, and she got in it, where's Netflix? January 17th, a long time ago. So I don't understand, what place were you in, let's say, a week ago, because our Netflix should have already had you up there pretty high.
First I was in like 8th, and then I bumped up to 4th.
So you've been in the top 10 for a while?
Yeah.
Okay, because of the Netflix. And then, has Amazon been doing that well, or has it just come around?
It's been up and down a little
Up and
bit.
down? And then, wait, is this yours? Am I jumping around here? Okay, and then you just recently bought Twitter and Coca-Cola as of today. Okay, now, before I ask her this, let's talk about the Dow Jones Industrial Average, kind of the temperature gauge of the overall market. And when we met last week, or Monday, 2 days ago, that ended up being, they're calling it the largest downturn ever in history, but what they're not clarifying is, in points, in the number of points, it was down like over 1,000 or 2,000 or something like that, I can't remember, 1,000. But as far as percentage, that is not the largest in history. A long time ago, when the Dow may have been at 6,000 or 5,000, it didn't go down as many points, but as a percent, it went down even farther. Because the Dow is a much larger number now, 12,135, over 1,000 points is a lot of points, but as a percent, it's not as big as some other times. So after we got going in class, the biggest, if you recall, I refreshed as we started class on Monday, and I was shocked at how much it had gone down just in the last hour. And that's really was a big deal. So with what happened on Friday, what happened on Monday, it was darn close to a correction, and we calculated, I think it was like 7.5% out of the 2 days. Then what happened? Tuesday, the next day, anybody know? Right here. Here's Tuesday. A sharp incline. And then here's today. I haven't refreshed it though. Matter of fact, I can tell this is already flattened out. We were actually having a good day, and things must have happened here in the last hour. Yeah, look at that. It was up 223, down 19. It went from up 223, down 19 in less than an hour, 45 minutes. And that's what you're seeing there. Now, if you recall, I said historically, after those 2 days from Friday and Monday, that if it comes back fast and gets most of that 7.5% back in a short period of time, does anybody remember what I said that will probably historically happens after that? Say it again. Like a bigger downturn, more like 10% over a short period of time instead of only 7.5 or more. I actually, earlier today, it was having a good game. And I was going to point out, these 2 days are almost heading towards where it's trying to say, we're going to have a bigger fall coming up fairly soon. A bigger one, so watch out. But now I don't know, because of what just happened in the last couple hours. I'm not sure. Now, I'm managing a trust that has a significant amount of money in, I believed what I said on Monday so much so that when I saw what happened yesterday and what was happening today, this afternoon, I started selling. I must have sold 8 different items, 8 different stocks. And I do it through Fidelity, so it's only like $4.95 a trade, so it's pretty cheap. But I said, you know, there's a good chance there's going to be a bigger one coming. I'm getting out. You know, I'm getting this money out of it. And so now I don't know. We ended up down a little today. So watch it. If you see in the next few days we have left, we have tomorrow and Friday left for this week, and if you see some significant gains, I'm talking maybe 2% or more each day, and then you add it to what's happened yesterday, then it's historically trying to tell us that we have a bigger downturn coming. If it just takes its time and slowly goes up, and let's say after the quiz next week, we get to talk about this again, and it's still on the way up, everybody could be okay. It could be just heading back up again, and we're not going to see that big downturn. So, at least historically, whatever happens in the past doesn't necessarily mean what's going to happen in the future, but there's a lot of people who do believe it. It does kind of give you a hint as to what will happen. So we'll see. We'll see what will happen. So you have to make decisions, you know, because you're talking about what your meeting you got coming. But you guys all got to make decisions on your portfolio as to what you think is going to happen. If you think it's going to go up, then you should get your purchase in for February. You know, buy some stuff. And if you think it's going to go down, you may want to get your transaction for February by getting out of something. Especially, especially when you made 20, I forgot what percent it was, 21, 22% over a short period of time. You haven't even sold half of it yet. So if you think there's a downturn coming again, you want to at least get out of half of that, because that's like hitting the lotto when you make that high a percent over a short period of time. Now, I don't want to give you a hard time. Was it you? Was it you? Hang on. But, where is it? Is this yours? That Twitter buy, you made a slight mistake. Not because you bought Twitter. I haven't been looking at Twitter to see how it's going to go. I'm sure there was some reason you wanted to buy it, and that's fine. But you bought too few shares. You were being conservative. You thought it was risky, maybe, and you only wanted to buy a few shares. But because you're being charged $6.99, Twitter has to go up such a large percent to get your $6.99 back. Had you bought at least $2,000 worth, it would not have had to work that hard then to at least get your money back. So I still say try to buy at least $2,000 worth of whatever it is you're going to buy, so that it doesn't have to work so hard to get you your $6.99 back at least. And then you're going to get charged another $6.99 to get back out. So you is this your buy right here? Yeah, you spent $270. Let's call it $271. If I divide $14, $6.99 to get in, $6.99 to go out. Now remember, it would be great if a stock went up 10% in a whole year. So you put you're saying divided by 271. Oh, I used the wrong number. Darn it. You're saying that this stock is going to have to go up over 5% just to get your money back, and the odds of a stock going up 5% is like, wow, that's, you know, especially when you only have 2 months left in the game. If you see it go up higher than 5% to get your money back, you may want to get back out or buy more. Or, I mean, you may want to buy more right now, but then you get another fee, so I don't know. No, you could buy more right now, $6.99, and if you sell it all at one time, you're only paying 1 fee instead of 2. You may be able to cover that, at least part of that fee that you put yourself in. You put the odds against you so much, it's like you got to play the odds. And you got to put the odds more in your favor by spending a little more. All right, one more before we go on. Where'd it go? Noelle, are you ready? She went from 31st place to 9th place in 1 day. That should give you hope.
Awesome.
I want you to know everybody's still in this game, and she's proving it. And and I looked, and it's not like you all of a sudden made some huge move. Is this yours? Is this your history? You actually kept the same stocks you bought in January. You haven't made some move that all of a sudden made you jump. Instead, one of the stocks you bet on in January finally turned the corner. You had this big loss in, it wasn't Netflix. Was it the time you bought Netflix? Hang on. I think it was Coors. I went ahead and looked. I brought it up here. Where is it? Netflix? Was it Netflix? No. Where's the other one? I don't tell me it got closed. How could it get closed? I think it was Coors. Oh, here we go. There it is. Right here. This is what did it. Something happened with Coors right here, where you had like a loss, and then boom, it jumped and gave you a bunch of your money back, and that's what skyrocketed you. Even though she's in Netflix, just like a lot of other people are in Netflix, that wasn't what gave that jump. It's when a stock has, when you see an upward cliff like this, like a rocket, that's what gives you that jump from one place to another. And that's what you, right now, a short-term strategy is, you all should be saying, how do I find that stock that's about to do a jump? And that's the hardest thing. How do you find it? And the way to find it is you got to read some obscure news articles that the average investor hasn't read yet. And you see something that jumps out at you. I just thought of the last time I saw an article that jumped out at me, and I thought, I bet a lot of people don't know about this yet. And it was, I read about this material called graphene. I don't know if anybody's ever heard of graphene. It's a new material that they found blanky blank years ago, and it hasn't really been brought into the market yet, and now all of a sudden, a whole bunch of products are finally starting to use this. It's supposed to be the stronger, like 10 times stronger than steel, yet so thin that it's only two-dimensional. And the graphite little bitty particles are hooked together like a lattice fence. And now a bunch of companies are saying, wow, what can we do with this? Nike just announced a brand new shoe. It's one of the lightest running shoes they've ever made, and they said the reason they were able to bring the weight down is they incorporated graphene with this special foam that they've had all along, and the combination has made this shoe so strong and so light that runners are going to flock to it. There's an example of where graphene's coming into the market. This other company said, we've invented these headphones that the sound is so sharp, so clear, and that it uses so less energy that you can turn it up and still have huge clarity because we've made the, can't remember what the thing is that vibrates, creates the waves, like a diaphragm inside the headphones. They use graphene. This particle, this material, I found a couple years ago, and I said, I gotta find companies who produce graphene that then sell it to other companies that can make things out of it. And that was my investment play, and I beat everybody to it. I remember talking to an engineer at Ford who said, graphene, because I brought it up like 3 times at dinner, 3 different dinners. And I brought it up again and again, and now the joke is they always bring up graphene. And he said, oh, what are you talking about? What are you talking about? And now there's supercars, not Ford not making it yet, but a couple others that are out there made of graphene. This is like some unbelievable, they realize this graphene has unbelievable conductor qualities, and they can get the electricity from batteries to last longer, to go farther, and not use as many and lighter cars, as far as electric's concerned, cars made of graphene. So that's the kind of thing you gotta look for. You, in real life, when you're finally ready to say, I wanna make that big bet that's gonna put me, do something big, it's a matter of finding that thing. When you start reading articles and you feel the hair on your arm go up a little chills, that's when you finally found it. And that's where you gotta go, okay, just focus on that and start reading as much as you can and see what you could invest in related to this thing that you just read about. That's how it is. You just gotta, if you do enough reading and investigating, you'll find it. All right, is that it? Look at Amazon. Not Amazon, let's go to, I know there was one here. Is it Hershey? Look at Hershey. Look, we talked about beta. This is the lowest beta I may have ever seen. Negative, when I say low, closest to 0 is what I meant. I call it -1 would not be low. Closest to 0. Negative 0.02. Does everybody remember what I told you what the beta means? So negative 0.02 is saying, historically, this company's stock price almost mirrors the overall average of the overall market, but slightly in the opposite direction. So very slightly. But look at how close it is to 0. If you probably put a graph of this stock price up to the Dow Jones Industrial Average or S&P 500 maybe, it would almost be right on top of it. What I want you to look at now, though, this is the new thing we're learning today, called the PE ratio, price-earnings ratio. It's taking their earnings, which is right down here, maybe, or is it? Oh, where is it? This $2, their earnings per share, $3.66. We're going to learn when we get to chapter 13 more about earnings per share, but that's how much. If the company said, hey, here's our profit for the last 12 months, and then they said, we're going to take the profit and divide it by all the shares that are outstanding, and they divide it by all the shares, each shareholder would get $3.66. That's the earnings per share divided into the price, the current price of the stock. So if I move this up, $99 is the price of the stock, and if you divide it by 3.66, depending on, this could be a day behind or something, you get 27. Most stocks are around between 5 and 20. Most, not all, but most. 5 and 20, they kind of call that normal. So when you see one that's at 27, 21, a lot of investors will say, well, we can't just compare that to the normal. We have to look at the history of the PE ratio of this company. And then once you have the history, and let's say the history is between, for this company, is between 10 and, no, let's go 10 and 25. Then you can really make a decision on what this means. This is higher than the highest they've been maybe for the last 3 years. Once you see, if you want to go back and look at their price-earnings ratio over time. And when you see a price-earnings ratio being on the high end, usually it means you're taking some risk. That this investment's already higher than it's almost ever been, and it's most likely going to be heading down, which means the price is going to be heading down, which means you're probably not making that good of an investment. It's too risky, and the odds are against you. But if this is the historical, and this PE ratio gets down to maybe 12 or 11, that could be an opportunity. What's going on in this company? If you don't see, oh, they shouldn't be, they're not losing money, they're hitting, they're doing the right thing, then this could be a buying opportunity. Because if this has historically been their range, they're probably heading back up, which means the price is probably heading back up, or the earnings. So price-earnings ratio is another thing you want to look at, and you want to compare to their average. But overall average is right around 5 to 20. Go ahead.
Do you say that the PE is the earnings per share divided by the current stock price?
Vice versa. Price divided by the earnings per share.
Oh, so the price of one stock
The
divided
price
by...
of one share divided by the earnings for one share, called, where's the earnings? Earnings per share, $3.66 divided into, what was it, 99? Yeah, so that would be it. You ready? Now I want all you Netflix lovers. Whoop, come on. Hang on. Look at the beta. Would you call that, conservative beta or risky beta? What? Because it's so far above 0 or below 0, it's risky. 1.5, 1.57, that's pretty far above 1. That means the ups and downs of Netflix are much bigger, 50% bigger than the average of the market. But look at the price-earnings ratio. Don't forget, what I tell you the average for most companies?
5 to 20.
5 to 20. What's this one? 213.
Well, what's its history? 'Cause
Yeah, that's right. But from the standpoint of most stocks averages, it looks like it's off the chart, which usually means this is a huge risk. But it's been working out for a lot of people. But if this is, since it's a positive beta, if this market goes down again, this stock is going to go way down, 50% farther than the average of the market, usually,
so
historically.
For the beta talk that we had, if the stock is going up,
No, go ahead.
if the stock is going up for them and it's a positive number for the beta,
Yep.
does that mean it's going to drop down?
No.
Or is that only when it's a
Let me state it a different way. If the overall market's going up, historically, this stock has also gone up on that same day and even higher as a percentage, 50% higher. So let's say the overall market went up 2%. This stock historically would go up, what, 50%, 2% is another 1%, so about 3%. But if, and historically, if the overall market goes down 3%, this stock, or 2%, then this stock is probably going down 3%. It has 50% higher ups and downs on average historically than the overall market. You got to look at it as it's trying to tell you how it does compared to the overall market on average. You can't look at it as it telling you what it's, you know, and what you've got to reflect it to the overall average market. That's what you basically. So if all of a sudden you turn on the news and it says the stock market's down, you know, 500 points this morning, you know, and you go to Netflix, it'll probably be, you know, 500 points. What percent's that based on where the Dow Jones, you know, or the Netflix is going to be down like 7.5%. You know, if that's 5%, whatever. So that's historically. Doesn't mean for sure it's going to go, but time has had it follow in the same direction, but with bigger up and down. The PE ratio is off the chart. So it's a high risk investment. But you're right. The PE ratio for Netflix has been up there for so long, like, you know, 3-4 years, that you got to look at its historic PE ratio to see what this PE ratio means. And the same holds true. If 213's on the low end of the range for the last 3 years, it could be a buying opportunity, even though the PE ratio is off the chart. If it's at the higher end, it means you're too late, probably, and you're taking way risk to get into it. So I just want you to have now a second item, other than beta, to kind of consider. And in real life, if you ever are considering ever buying real stock, you need to know this and a lot of these other numbers so you can make clear decisions. It's all about putting the probability in your favor, because just randomly buying stocks, you're putting the probability in the favor of the other investors who are going to take advantage of you, because they know when to buy and sell and you don't, and when you don't sell and they're selling, they're making money off you. So that's how it works. You don't want to be the rookie. All right.
Where do we find its past history?
You know, that's a good question, and I did a Google search, and there's a whole bunch of sites, and the one I opened up, is this it? Where is it? Here it is. It's called, just because it was the first one on the list, Macro Trends. I just wrote the words PE ratio history for stocks, and I saw Apple on the list, so I opened it up, and look at the PE ratio. This one's showing you that bottom line here is the PE ratio for Apple, and they got it going all the way back to before 2008. What do you think this is all about? This was the financial crash of 2009 to 2008, beginning of 2009. That's what that's all about. You can see the PE ratio, you know, doesn't really fluctuate that much. But I didn't take the time to figure out how to switch to another company. I'm sure there's an easy way to do it here. What was the one we were just talking about? Netflix? NF, what is it? L, something X? Let's try it. There's our answer. Nothing. Is it still going? There's nothing there. So, all right. But there are a lot of sites where you can get past information, especially, let's say you're buying something. Since that lecture I introduced you to beta, and I said, hey, write down the beta if you buy a stock. The paper may be asking you, what was the beta when you bought the stock that you're going to write about? And you can't find it, you're going to want to find one of these pages where you can find the history of beta and find out what it was the day you bought it, so you can include it in your paper. All right. That's enough of Investopedia. We talked about it a little bit at the beginning of each lecture, just so you can get more familiar with it. More people, there's still people who aren't quite, you know, excited about it all, and that's normal. That's fine, but you gotta at least participate a little bit so you can have the experience, so you can make a clear decision that you never want to be in stocks the rest of your life. You don't want to take that kind of risk, and that's fine. All right, let's get to investing. We're on chapter 11. You know what? I want to go to the pyramid of risk. I don't remember the page. 361. I'm going to jump around a little bit, but I want to keep it interesting. Okay? The pyramid at the top of page 361. I'm going to put this all together. I want to start it right here. Employer Retirement Program. I brought this up already in a couple previous lectures, but the reason I'm bringing it up right now is because I want you to remember this. Remember that I told you you're going to have that human resource meeting when you get that new job, that you're going to about to make more money you ever made your whole life because you got your degree, blah, blah, blah. And they're going to say, hey, how do you want your retirement distributed? Here's the 12 or 15 choices. What percent do you want to go into this or that? Well, a lot of companies also are going to tell you, hey, we offer a matching program. And the matching program is where it says, if you're willing to put a certain amount of money into the employee retirement program, here where you work, we will match it up to, and then there's always an up to. A lot of companies are using 5%. So as an example, your first payday is about to come. And you went ahead and said, yes, you checked the box, yes, I do want to be in the matching program. You want to make sure that whatever it takes to get the maximum matching, like if the company says, you can put in whatever percent of your pay into this retirement and we'll match it, then it will say up to 5%. Meaning, if you put in 6%, they're still only putting in 5. You put in 10%, they're still putting in 5. There is no reason to put in, as we get farther in this class, you'll understand why I'm saying this. There's no reason to put in more than whatever it takes to get exactly the most you can get in the match. And you never, ever, ever want to put in less than what it takes to get exactly the full match. The matching is free money. And if you say, I can't afford to have that taken out of my paycheck until a year goes by, you're throwing away a year's worth of money because once it goes by, you can never go back and get it. The company keeps it. And you just passed up an opportunity for free money. Let me make sure you understand. Let's say $200 came out of your paycheck and went into that retirement program. And they're matching it $200. You just doubled your money in a second. The moment your money goes in, their money goes in, and you just doubled your money. And you're guaranteed to double. There's nothing in your life from that point on that you'll ever have a guarantee to double your money in 1 second. And so you want to make sure that you're constantly doubling your money, exactly whatever it takes, to get all the money they're willing to give you to double it. Now, this employer here at U of M, they put in $2 for every dollar you put in. Every time they take money on my paycheck and put it in, they put twice as much in. I'm tripling my money in 1 second. And so when you have an employer offer something like that, you have to. No matter if you can't afford it, you have to check that box that says, I'm putting in exactly 5%, and they're putting in 10%. And I tripled my money, even if you don't think you can afford it. I don't care if you have to go borrow money to cover what you think you can't afford, because you can't afford not to take that tripling your investment in 1 second, because it will never come around again. And only your employer is the only one that's going to offer you this opportunity. So you have to do it, please. Now, when you go to do it, you've got that question. Hey, what do you want it to go into? And up here is the pyramid of risk. The things you see at the bottom are the least risky. The things at the top are the most risky. And we're going to learn what mutual funds are all about, but each mutual fund has is built with the things you see on the pyramid. For example, look at level 2. U.S. securities, that's stocks. U.S. securities, selected corporate and municipal bonds. I'm sorry, let me go back. U.S. securities are government bonds. Selected corporate and municipal bonds. Income stocks. The word income with the word stock means these are stocks that pay dividends to shareholders. There's a lot of stocks that don't pay dividends, but the ones that do, they're called income stocks. They're considered less risky by a lot of investors. And conservative mutual funds. Now, you'll see this list of mutual funds, but what you won't see is, well, what's inside this mutual fund? And they'll have additional paperwork. Oh, here you go. Oh, you mean there's some U.S. government bonds called U.S. securities, selected corporate and municipal bonds, income stocks, and all in this mutual fund? Yes. You now know that that would be level 2 risk. Well, what about this other of the 15 choices? This mutual fund here that I could select to have my retirement go into. Oh, that's made up of, go to level 3, growth stocks, growth-oriented mutual funds. We also have some rental properties that this mutual fund manager has in this mutual fund. It won't be rental properties, it won't be part of retirement, but it will be mostly stocks, more riskier stocks, the non-income stocks. And that will be riskier. But you won't see anything that says that one's riskier than this one. And then you'll see another mutual fund that says, well, what's this one called? This one has the name something something money market fund. The word money market fund, that's level 1 risk, the lowest risk. And that's like putting your money into a savings account at a bank or credit union. Doesn't do very well, but if you think there's a downturn in the market, that money will not be lost. That money makes money no matter if the market goes up or down, but it just makes it very slow. Right now, 1% a year. I mean, that's very slow. But if you think there's any risk of the stock market having a big plunge down, you want to say, I want my retirement to go into that money market fund right now until after some kind of big downturn takes place. Then you get online and you switch it then to the more riskier ones to ride it back up. Most people just check, let's go with these 3 mutual funds. And then they never look at it again until they're ready to retire. 30 years go by, they have no idea of all the different things that have happened in their retirement fund. So it's the one who keeps an eye on it, manages it, and understands when to shift money and what to shift it into, they're the ones whose retirements after 30 years are almost twice as large as the person who selected the boxes on day 1. 30 years go by, they got some nice money in there, but why did the person I got hired in with, they're retiring right now too, why is theirs twice as large? Because they watched it and they made shifts at the right time, and they understood what the risk involved with each of the mutual funds. That's why they made twice as much over the 30 years in their retirement than you did. So that's what this is all about, is understanding this risk. This chapter is introducing you to investment basics, but it's all about bonds. And several of the mutual funds that will be on that list are all bonds inside of it. Some of them don't have any stocks at all. Some have the risky stocks, some have the conservative stocks, and then there's mutual funds that have bonds, and then there's some mutual funds on your list that will have both bonds and stocks, called balanced mutual funds, because they're balancing both. Those are all choices that you're all going to face when you have to make those selections when it's time. I don't know where that went. I heard it though. All right? So we're talking about bonds right now. The next chapter we're going to be talking about stocks, because those are all in those mutual funds. And then the next chapter after that is going to be all about the mutual funds themselves. So you understand the common names that you'll start recognizing. As soon as you see that list and you understand the names that you're going to learn from that mutual fund chapter, it'll say blankety blank income fund. Oh, there we go. This one's made of stocks or bonds that are paying dividends. The word income in the name of a mutual fund means whatever's inside it is paying dividends. Blah, 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 growth fund. Oh, the word growth is in the name of that one. Oh, this one then has a bunch of stocks that don't pay dividends, that are companies that are on the growth path and have usually higher than expected growth compared to other companies. Usually considered a riskier mutual fund. You'll understand this list when we get to the point of going over those names, because they all have common parts of their names. So here we go with bonds. Bonds. This is where a company or a municipality says, we need some money. We need new sewers. Man, our township, I'm pretending like this is a township. Oh, our sewers are falling apart. We don't have the money to get new sewers. We're going to have to borrow the money. A township may go to a bank or a credit union and say, hey, can we borrow $5 million? We've got to redo the sewers in our township, and we'll pay it back over 20 years or something. And they'll say, yeah, sure, and here's the interest rate we would give you if you borrowed it from us. And then the township says, well, let's call a brokerage firm or a finance company like Morgan Stanley, and let's see if we could do what's called a bond issuing. When they decide to raise money using bonds, they're saying, hey, investors, lend us your money. We're going to give you this bond in trade, and we're going to pay you back over time, just like we would have paid the bank back. But instead of the bank making the interest, we want you guys to make the interest. So come buy our bonds through, we're going to sell these bonds on this date at this time. Hey, investors, come get them. Those are called municipal bonds because it's municipalities trying to raise money. And if it's a municipal bond from a township or the state of Michigan or Detroit or Flint, they're tax-free for the investor. Everybody hear that? Municipal bonds are attractive to a lot of investors because there's no taxes on them. Every time you make money off these bonds, no taxes. Tax-free. Now, corporations do the same thing. Apple, IBM, General Motors, Ford. We need to raise money. We're going to go into this new electric car thing or self-driving, but we need to raise some money, you know, to launch this whole thing we're about to do. They go to the bank. The bank says, sure, we'll lend you the money. What do you need, 10 million? All right, here's 10 million. Here's the interest rate. Here's the payment back plan. And they said, what if we had investors instead? They go to a place, Morgan Stanley or Merrill Lynch, and they say, we're thinking about doing a bond offering, and the finance company will help them. And they'll say, all right, let's get this set up. Here's what we think the interest rate you'd have to pay to investors in order to attract investors to buy these bonds, to invest in these bonds. And those are corporate bonds, and they are taxable. An investor makes money off a corporate bond, they got to pay taxes on the money they make. So, let's say, right now on the exact same day, Flint, Michigan wants to borrow some money, redo water lines. And I'm trying to think of a corporation. McLaren Hospital, they need to raise some money too. And they're both, Flint and McLaren Hospital, are going to do a bond issuing. Is McLaren a for-profit hospital? This could be a bad example.
Yes, they are.
Okay, let's do that then, because they're a corporation. Now, you heard about both these bonds, and you're getting into investing. And you're thinking, you know, I'd like to invest in these bonds. And almost all of them will sell however many bonds it takes to raise the money they're looking for, and each bond is almost always $1,000 a bond. So you're thinking, oh, I'll do $2,000 at McLaren's, and I'll throw $2,000 at Flint's bond issuing, and they're going on the same day. Now here's the deal. McLaren's bond says, we'll pay 5% interest a year for whoever takes our bonds. For every $1,000, you get a bond, and it's going to pay back 5% a year, and you're going to get a check in the mail every 6 months, twice a year. So let's say it's 5%. The Flint municipal bond, hey, we're thinking about buying those. Here's $2,000, but they're only going to pay 4% per year. So as an investor, you're probably going, well, why should I buy those bonds that are only paying 4% when I could buy this bond the same day, it's going to pay me 5%? And you're going, maybe I would want to make 5% over 4%. But what a lot of investors who are just starting out don't take into consideration is that the money, this 5% you're making, you've got to pay taxes on it. This 4% you're making, no taxes. So you're not comparing apples to apples. You can't tell just by looking at this which one's the better investment until you calculate. Either you need to convert this one to its non-taxable equivalent and then compare it, or convert this one to its taxable equivalent and then compare it. Then you can make the best decision which one would be doing better. That's the difference between corporate bonds and municipal bonds. So what you're about to see, a lot of people freak out at this calculation. I'm going to slide, there it is, 17. Come on. This calculation on slide 17 is what will allow you to convert one or the other, so now you can compare it to the other and apples to apples. You only need to convert one. Either convert 5% to its non-taxable equivalent or convert 4% to its taxable equivalent. The formula is the same, it's just which number you're using. The tax-exempt yield is in the numerator. 1 minus the tax rate. What percent would we be paying taxes on this corporate bond would be the denominator, and the taxable equivalent is what it equals. Now, if you already know the taxable equivalent, that would be here. This would be 1 minus the tax rate, and you'd be calculating this. You'd make this x and do algebra. This times this then equals that. But if you're given the non-taxable rate, you put it here and divide by 1 minus the tax to turn it into its taxable equivalent. And let's do that, because most people like to do it that way the best. I'm going to take this 4%, I'm going to divide it by 1 minus the tax rate, and I'm going to see if we had to pay taxes on it, what would that percent be? Now, let's say you're not in the 28% tax bracket right now. Maybe you're only in the, let's say you're in the 20% tax bracket. So I'm going to use 1.0 minus, I'm turning the tax rate of 20% into a decimal, 0.20. So 1.0 minus 0.20 equals what? 0.80. 100% minus 20% leaves you with 80%. Now take 4 divided by 0.8. Here we go. 4 divided by 0.8. You took your taxes out, you kind of estimated how much you'd end up, what percent you pay on your income in taxes. And you go, I'm paying about 20% in taxes on my federal tax return, so I'm going to use 20%. And you go, oh, if this were taxable, it's the same as paying 5%. But it's only at 4%. But because we don't have to pay taxes on it, it's the same as making 5% on a taxable one. You're giving up 1% in taxes. So now, this corporate bond from McLaren's at 5%, Flint is issuing municipal bonds at 4%, it's also the same as 5%. These are exactly equivalent investments. Now it's just a matter of determining which one would be more risky, investing in McLaren or investing in Flint, because they're going to pay the exact same rate, taking the fact into consideration that one's non-taxable. Go ahead.
So, and that probably just did it in the denominator. You changed,
The
you
tax
changed,
rate
but
to a decimal.
but in the numerator you didn't do that.
You can.
You can't do
Then
that?
you'd have to move it again. I just took a shortcut. Here we go. 0.04 divided by 0.8 is going to be 0.05. And then I moved the decimal.
Okay, I got you.
So
Yeah.
equals 0.05, and then move the decimal 2 places, 5%.
Okay.
I took a shortcut. I should have pointed that out. Thank you. All right? Do you see what I did? Let's do it the other way. I'm going to convert the corporate bond to its non-taxable equivalent so I can compare it to the city bond. This time, 5% equals, I don't know what its non-taxable equivalent is, divided by 1 minus the tax rate. I'm doing 0.2 again, which would be 0.8. So x divided by 0.8 equals 5%. Algebra says multiply both sides by whatever that denominator is, which is 0.8. So 5% times 0.8 is going to equal its non-taxable equivalent. So we take, now do you want me to use decimal? 0.05? 0.05 times 0.8 should be 0.04. 0.04, now move the decimal 2 places, 4%. This McLaren taxable bond's paying 5% interest, but if we didn't have to pay taxes on it, it'd be the same as making 4% interest. This municipal is paying 4%. They are exactly going to pay the same to all investors. It's just a matter of trying to decide which one's less risky. If we're only going to pick one or the other, which one would be less risky? In my opinion, the McLaren would be less risky. Only because Flint has a bad history of not being good on handling their money. And that's why they've had emergency managers, because administrations over the years, and this goes back even before you were born, I can remember emergency managers having to be assigned to Flint even before you're born, because administrators in Flint, for some reason, are spending more than the taxes coming in, and they end up running out of money, and then the city gets into trouble, and then they have to get an emergency manager to come in and try to help stabilize things, and then they hand it back to the city council and the mayor, and which is, we're in the transition of handing everything back to the city council and mayor right now, and the emergency manager no longer taking place, so things are turning around. But what has happened the last couple of years, it's about the 5th time it's happened in the last 20 or 30 years that Flint has been on the brink of bankrupt. Detroit, they're the largest municipal bankruptcy in history of the United States. And it happened a few years ago. So that's how bad things got in Detroit. And I think they have a mayor, but I think as far as handling the financial decisions, they may even still have an emergency manager in place there, I'm not sure. So everybody get that formula? That's the hardest part of today's lecture, is that formula, the tax equivalent formula. Let's get to some of the other stuff. I'm going to slide 3. Hey, why didn't anybody remind me? Got that sign-in sheet. There's no ink class today. All right, here it's talking about, on slide 3, it's talking about establishing investment goals, you know, getting ready to start investing. And the number one thing you're saving for, the first thing you're saving for right when you get out in the real world is emergency fund. Emergency fund's number 1. I'm jumping to 4 because we've talked about that. This slide says your emergency fund, start an emergency fund, is money you can access quickly, liquid assets. Remember that definition? The checking account, the savings account, a money market fund is like a savings account at a mutual fund company. You could get online and get that money wired the same day. It's very liquid. They don't have to sell stocks to get you your money. It's like a savings account. This slide says your emergency fund should be 3 months living expenses. We happen to be in an economy where finding another job is pretty quick, but I think I said closer to 4 months, I think is what I recommended. Is that true? Where there, in 2009, 2010, I was telling people a year's emergency fund, a month, 12 months expenses, because that's how long it was taking people to find another job, similar to the kind of pay they were receiving when all those layoffs took place. Remember, that was 500,000 people getting laid off every month for several months in a row in our country. 500,000 every month. So it was very difficult to find another job in only a 3-month time. At this point, 3 months, 4 months, I'm saying 4 months. I'm a conservative person. I used to always have an emergency fund for 6 months at least. So, and that was even during a good economic time. But slide 3, the one thing I want to point out is, if you ever say, you know, I remember something from personal finance, and that is that if you change your habits and become a saver and saver, you could retire early. It's not just changing your habits on how you spend money, but it's this. Where is it? Willing to make sacrifices. And what I mean by that is, I can't tell you how many years that everybody said, you know, I worked at a place where everybody took their vacations during the summer. And I remember saying, you know what? A vacation's at least $5,000. And if you add up the rental car, the flight, the hotel, everything. And I thought, and I can't tell you how many years I said, you know, everybody have a good time. I'm going to go home for a week. And I'm going to save $5,000. And that was a sacrifice, because vacations are healthy. They're probably good for you, but for me, my goal was I wanted to get done with working as fast as I could, so I made that kind of sacrifice. Skip the vacation, leave the money in the bank, let it keep investing in it, and keep letting my money work for me. That's all. That's what I focused on. And it's like that. If you're willing to make sacrifices, it will pay off. But it's a lot of sacrifices. I went to a crazy world that sacrifices. Just so you know. What's the temperature in my house right now? 48. When I get home, it's 48. What is it at your house?
60.
What's 20 degrees? What? You can't handle
Don't your
it?
pipes freeze?
How many layers do you wear?
3?
3?
Yeah, and until the room I'm in warms up from the space heater.
There you go.
What if your pipes freeze and you have to pay someone to come fix them?
Pipes don't freeze at 40. I even leave the sink cupboard door open so the 48 degrees gets to the pipes.
Oh.
I do. At this particular time. All right. So where am I now? Sacrifices, emergency fund, 3 to 4 months. We're going to 5. This one's all it's doing is saying, make sure and participate in your employer-sponsored retirement program, especially if they have matching. If they offer matching, you must participate and get that free money. Next, we're going to page 369. I said to you that bonds will always put on, they always state what the interest rate is that they pay interest on, called dividends. And if it's at 5%, then you can calculate how much the dividend or interest is going to be for a year. But bonds traditionally send the checks out every 6 months. So if you own bonds, twice a year you'll get a check in the mail for whatever percent. It doesn't change. Whatever, when you bought that bond, whatever percent was on that bond is the percent you get for as long as you own that bond. So if it's 5% in almost all bonds, and for this class, every single bond will be $1,000 face value. So to figure out how much you'll get interest, $1,000 times 5% equals $50. Divide by 2, that's $25 every 6 months. That's the interest calculation right down here for the year. Face value of the bond says $1,000. For this class, they'll all be $1,000 face value, times the percent. It says it's a 4% bond, so you're going to make 4%. Multiply it out, that's $40, but the bond pays it twice a year, so the check that comes will be $20, and then 6 months later, another $20. 6 months later, another $20, and so on. You'll hear, later in life, you'll hear how a lot of elderly people love bonds because they love that check that comes every 6 months to supplement the Social Security. You're like, I can't live. You ever hear your grandmother or grandfather go, oh, I can't live off Social Security? So they have bonds, and they get, every 6 months, they'll get a check. Get these checks, because maybe they own several bonds, and so they're getting checks from them every 6 months, and that's their supplemental income. So that's where bonds come in. No different with municipal bonds. $1,000 times 4%, this one's $40 a year, $20 every 6 months, but this one's tax-free. You don't have to pay taxes on this $40. You do pay taxes on that $50 that you're going to get over the year. 25 and 25. All right. So there's the interest calculation. What's next on here? Interest calculation, bond comparison, we did that calculation. Current yield, slide 26. Current yield. All right. You ready? You own this bond, this corporate bond right here. This was called McLaren thing. And you've had it for 10 years. And you're going, gosh, this bond is a 30-year bond. I could hang on to it for another 20 years and keep getting that $50. And at the end of the 30 years, whoever has that bond turns it back into the corporation, and you get the $1,000 back. And you made the $50 every year on that $1,000 until the end of the bond. But there's all kinds of people who can't hang on to that bond for 30 years, and they want to sell it. Now, if you sell it on the open market, you may not get $1,000 for it. You could get more than $1,000. You could get less than $1,000. $1,000 was the initial price for the first person who bought that bond. After that, if they resell it, it's usually at different prices. The bond always pays 5% of $1,000. That's why it's called face value, because that was the original price. But the person who buys it, they're also only getting $50 no matter what they paid for it. If they paid $1,100 for it, they get $50. They paid $900 for it, they get $50. So investors always want to calculate what their percent of gain would be if they don't pay $1,000 for it. So the formula is, whoops, you tell me. The formula is to take the annual interest amount, like $50, divided by the price that you'll have to pay for that bond, because it's not a brand new bond being issued at $1,000. Somebody's trying to get rid of a bond, and the price is, well, look at that. The price is $900. You could get a bond at $100 less. And if you hang on to this bond at the end of the 30 years or 20 years or however long that bond maturity is, you get $1,000. You get your $900 back plus the $100. The person who sold it to you is the one that lost that $100. They had to sell it at a discount from what they paid for it just to get it sold because they needed the money. So what percent did you make on that bond each year? Since it took you $900 to get it, but the bond was originally $1,000 paying 5%, so it's going to pay $50. So $50 divided by 900, because you got the bond for at a discount, you're going to make more than 5% off it. $50 divided by 900, you're going to be making 5.5%, a little over 5.5%. 0.055, put a line over it, 55555. You're making a better percent than the original person, because the original person had to sell it for $100 less than they paid for it, because they couldn't keep it to maturity. They need the money. They had to sell it at a discount. And so you took it. You said, "Wow, look at this bond's only $900. Let's grab it. It's going to pay $50. I'm not going to just make 5% on it. I'm going to make 5.5%." 10 years go by. So now this bond only has 10 years left to maturity, and now you can't keep it. Now you need the money for whatever happened. And so now you need to sell it. You want to get as much as you can for it, but you end up only being able to get $850. You're going to have to eat $50 on a bond you got a great deal on, because the only way you could find a buyer for it is to sell it at even more of a discount. What percent will the new person who owns it for those last 10 years, or however long they keep it, are they going to make? Higher or lower than the percent that you were making when you owned it? Higher. Because they got it at even a bigger discount. It still pays $50. The same as originally. The 5%, anytime you're told about a percent on the bond, it's always that percent times the original price, or what's called face value, which is always 1,000 for this class. And so anytime someone can get it for less than 1,000, they're making a higher percent. $850 divided into $50. So their percentage is going to be $50 divided by 850. They're making 0.058882. So this person was making 5.5%, this person's making 5.8%, because they got even more of a discount by buying a bond on the open market from someone who needed to get rid of it.
And you always go by what you make in a year, not every 6 months.
That's right. Because every time we talk about percentages in this class, it's always a year. All those future present value questions, or all the percent given to you, is what was made on a year. Same with all of these, it's all the percent on a year. All the ads you see on billboards and stuff, that's the percent per year.
So when you say the bond comes to maturity,
Yes.
what happens?
You ready? This person says, I'm going to hang on to it for those last 10 years. And now it comes to maturity. And they contact whoever, there's something on the bond, who to contact, and it says, hey, this is maturing. Yeah, let's hand it in. Let's go. Let's make the trade. This person, not only did they make $50 every year off their $850, but they're going to get the $1,000 at maturity, an extra $150, and they only had to hold it for those last 10 years. So if you take that into consideration, in the big picture, they averaged even more than 5.8%, because they held on to it to maturity and got that extra $150 that these two people had to eat because they needed the money and they had to sell it on the open market. Does everybody understand how the basics of bond investing? Almost universally, investors find bond investing less risky than stocks. And so when you get to the point where you go ready to gamble money, think about taking less risk with bonds instead of stocks, and then go to stocks down the road, because you're taking less risk and still can make good money off of bonds with much less risk. I want to point out one more thing as to why bonds are less risky. If a company ever goes bankrupt, they take all the assets and sell off all the assets. They pay off all the liabilities, whatever they're owed, and then what's left over goes to investors. And it goes in this order. 1, whoever has bonds gets their money first. Is there any money left over? Sometimes there is. Number 2, whoever owns what's called preferred stocks, nothing we've studied yet until we get to that chapter, they're second in line. And now, in most cases, there's almost nothing left over, but if there is, the last ones are called all this gain, we've all been buying and selling in the simulation common stock shares. They're last to get their money, and this is why investors find stocks to be the absolute most riskiest investment out of compared to bonds and preferred stock. Everybody see the order? That's why bonds are much less risky, plus the way they're set up and da-da-da-da. All right, we'll pick up from here then on Monday, and then Wednesday's the quiz. Thank you. Thank you for moving it.